Appreciate you taking the time to check out another video from NetPicks. And today, I want to ask you, why do you think that I think the 3-bar inside bar strategy is worth your time taking a look at? I'll tell you, because at its core, the inside bar, it's actually a triangle candle chart pattern. Now, it's not going to be perfect. Okay, so I want you to think of the concept of that. And the third bar in the strategy is the break of that triangle. Now, anybody that's ever traded a break of a triangle, you know that the breaks can go pretty quick into profit. Even better, sometimes you can catch the trend of an extended price move. And looking here, this is what an inside candle looks like. Now, there's some debate whether an inside bar can have its high or its low or both equal to the first candle. But for me, as long as it remains inside the high-low range, it's an inside bar, okay, and price is in consolidation. Once price action starts to move one tick or a pip outside the range, well, then it's no longer an inside bar. However, once we have equal highs and equal lows, we actually have more of a trading range, a sideways range, and less of that triangle setup. So if that does happen, I don't expect the same reaction, okay, once that pattern does break. And we're going to talk about the rules in a minute. So when we see an inside candle, a trader should see that there's a pause in the volatility of the price movement. Okay, it's these pauses that we want to take advantage of. So here in this graphic, you can see a few things we just talked about. You can see that inside bars resemble triangles on lower time frames. And you can have multiple inside bars inside of that one main bar called the mother bar. Now this stock eventually does gap up and overtop the triangle and over top of the mother bar during that breakout. And once you see the rules, you're going to see why this is not a trade you could have taken anyway. It's just an example. So what are the rules? Well, this strategy is going to take long and short trading positions, okay? Otherwise known as positive and negative reversals. That is what I can't even pronounce the guy's name very well, Johanan Prathap, sounds pretty close. That's what he would call them. Now you can use time frames, including a daily chart, a weekly chart, even 5-minute charts, more of an intraday time frame. This graphic is an example of a completed 3-bar reversal. Now this market was actually tested on by the designer of the strategy, gold, silver, and crude oil, and he used daily data. Now buy trades. Number 1, the first bar closes up, indicating buyers stepping in or sellers unloading positions, and a possible trend upwards. Number 2, we have a second bar forms inside the entire range of the first bar, becoming an inside bar. It's pretty much a pullback in price. And the third bar will close higher than the close of the first candle, completes the pattern, right? It's also the entry price, and that's the closing price of that candle or close to it. On this chart here, this is a 1-hour stock chart. So we're going to ask ourselves some questions. Do we have a candlestick closing up to make a candle number 1? Yes, we do. That's those black arrows. It's a potential long setup. Do we have an inside candlestick forming? Yes. Third question you want to ask yourself, does that third candle close higher than the first candle? Yes. Well, then we have a trade in a potential uptrend. But now I want you to take a look at that area with the star. And this is where details matter. The rule is that the third bar must close at a higher price than the first bar for a long trade. Okay, so in fact, the actual rule is written like this. Close of the bar number 3 is greater than the close of bar number 1. Now, price does not have to break the high. So if that candle number 1 would have been green, okay, the close would have been higher than the open, this would not be a trade because the close of number 3 would have been less than the close of number 1. Okay, details. Now on the right, those setups are inside the main mother bar, so you have some choices to make. Number 1, would you still take those trades? Number 2, would you enter your trade after a breakout? And number 3, would you skip that sequence? So whatever you choose, make sure you test it out, put it in your trading plan. Now for the sell, it's the exact opposite of buys. the first bar will close down. The second bar closes inside the extremes of the first bar. And lastly, the third bar will close less than the close of that first bar. And this is a 4-hour Forex chart. This is not the best example because the candle number 1 of that 3-bar inside strategy, it shows obvious signs of lower price rejection, right? It's more of a reversal type of candlestick. So you have to define what you need the real body of that bar number 1 to look like. Do you need small shadows? Can you have a long upper shadow for short trades? Make that opposite for longs. Can it be a doji? So we do have the inside candle, and the third bar does close lower than the first bar. So I want you to note that if you're using a rule where price has to make a new low lower than the first candle, it actually does in this example, but just barely. And this trade here, you get zero momentum, nothing in your direction. It starts to go up. You probably would have got stopped out. And just know that every trading strategy is going to have losing trades. So talk about losing and winning. We actually need a place to exit our trades in both profits and in losses. Now, the original strategy for that system would exit at a stop loss of 0.75% or a profit target of 0.75%. I'm not a fan of using percentage-based stop losses or even targets because you never know how far a trade can actually run. Right? Stops that are based on a percentage does not really take into account current market volatility. And my go-to way of setting stops and targets is using the average true range and trailing stops. So right here in this stock chart, I want you to assume that the ATR reading of 14 periods is 0.38, okay, 38 cents. And we're going to use a multiplier of 1 ATR. Now we have a valid 3-bar inside bar setup. Number 1, our stop loss location is set at the closing price of the candlestick minus 38 cents. The first scale out is 1R, or once that trade goes in our favor equal to the risk on the trade, we're going to scale out a third. Number 3, this is our second scale at 2R, right? 2 times our risk. Once the trade goes 2 times our risk, we could scale some out. And number 4, during the up move, we actually use a trailing stop at 1 times the ATR minus the close. So we're taking out of the remaining third at that solid black line. Okay, this is just one example that you can use with a strategy. Whatever you choose, just be consistent. So let's wrap it up. This 3-bar reversal uses an inside bar and takes advantage of the indecision in the market. Okay, not only is it indecision, but on lower time frames than your setup, you're going to actually see a pullback in price. This signal begins to show up when you have an inside bar that you can easily scan for that. The reversal pattern is complete once that third candle takes out the close of the first candle. Now, traders that are in profit on the original setup, you may consider using further setups as continuation patterns. So once that reversal is complete, you just add to your current position. Now, the biggest change that I would make is to ensure that you're looking at a trending market. And you can use a simple trend structure of higher highs and lows for an example of an uptrend. And I think that could add to the success of each reversal, especially when we're looking at a really smooth trending market. Thanks for watching. Any questions, comments, hit below. Subscribe, and we'll see you in the next video.